Disclaimer: on January 9, 2026, an event unfolded that should compel every American investor to reassess their understanding of precious metals markets. Goldman Sachs, a titan of Wall Street, issued a rare and direct warning to its clients regarding silver. The specific language they used reveals a critical truth about who now holds power in this market. The bank cautioned that extreme price swings, both upward and downward, will persist in silver markets. For those familiar with financial communications, such a stark volatility warning from Goldman is never arbitrary. It signals something significant. Translated, their message indicates a loss of control over market pricing. The evidence lies in the market activity of early January 2026, which tells a story the financial establishment prefers to obscure. On January 7, silver reached a record high of $81.16 per ounce on the COMEX futures exchange in New York. This is the official, widely reported price. Within 48 hours, it fell 7.5% to the $75-76 range, a seemingly normal correction. However, this narrative shatters against a stark discrepancy. While New York paper prices traded at $75, physical silver bars were simultaneously selling for $130 per ounce in Tokyo and Dubai. This represents an 80% premium, not a minor arbitrage gap, but evidence of two entirely separate markets. What we are witnessing is the failure of Wall Street's paper pricing system for silver, triggered by a policy change enacted 8 days prior to Goldman's warning. On January 1, 2026, China implemented new export licensing rules for silver, radically altering global supply dynamics. They restricted licenses to companies capable of handling shipments of 80 tons or more. This technical move had a devastating impact. Before January 1, roughly 500 Chinese firms exported silver. Afterward, only 44 qualified. China did not ban exports but created a controlled channel, eliminating 90% of the exporters who provided liquidity to Western markets. Given China controls approximately 65% of global silver supply, these restrictions severed the arbitrage mechanism that kept paper and physical prices loosely connected. Arbitrage is the foundational process that aligns global prices. If silver is cheaper in New York than London, traders buy COMEX contracts, take delivery, ship the metal, and sell it in London for a profit. This activity naturally equalizes prices. China's restrictions disrupt this entirely. The physical metal needed to balance prices is no longer freely available for export. The approved 44 exporters now prioritize domestic industrial customers. Consequently, COMEX paper prices become increasingly detached from reality, as actual industrial buyers in need of physical metal for manufacturing pay whatever is necessary in markets like Tokyo and Dubai. Goldman Sachs analyst Lena Thomas provided mathematical proof of this breakdown in her January 9 report. She noted that silver's price sensitivity to demand changes jumped from 2% per 1,000 tons to 7% per 1,000 tons, at a 350% increase in volatility. This is not merely higher fluctuation, it signifies a fundamental failure. The quantitative models used for decades by Goldman and other banks assume open supply chains and functional arbitrage. These models cannot function when 65% of global supply is ring-fenced. Thomas's technical language quietly admits their pricing frameworks are broken. The economic implications are profound. Silver is a critical industrial metal consumed in solar panels, electric vehicles, AI hardware, and medical devices. These industries need physical metal, not paper promises. When industrial buyers realize COMEX prices no longer reflect true physical acquisition costs, they bypass New York and pay the premiums in Tokyo or Dubai. Goldman's warning was not about protecting retail investors from volatility, it was an admission to institutional clients that the hedging and pricing system they have relied upon has mathematically failed. Their message, decoded, is simple: we no longer control this market, and our models are obsolete. This is not mere Wall Street caution. Documented evidence shows the physical supply crisis has been building for months. In October 2025, a single 1,000 ton delivery order in London caused silver lease rates to spike to 200%, annualized to 100 times the normal level. This indicated a severe physical shortage, causing a market freeze. Around the same time, the Swiss refiner Metalor announced it would not return to silver trading before January 2026 due to counterparty risk. A major refiner exiting the market because it cannot trust others to deliver physical metal is an unprecedented event signaling deep systemic risk. COMEX warehouse data corroborates this strain. Registered silver inventory of metal available for futures delivery collapsed 70% from 346 million ounces in 2020 to just 82 million ounces by late 2023. As of January 7, 2026, Total warehouse stocks are 445.7 million ounces, but most is eligible inventory not made available for delivery. With COMEX open interest at record highs, the ratio of paper claims to available physical metal is alarming. If a significant number of contracts demand physical delivery, the exchange faces an impossible choice: find metal at any price or default. Further evidence comes from institutional behavior. The December 2025 CFTC Commitment of Traders report shows major U.S. banks refused to add new short positions even as silver rallied toward $84. In normal markets, banks would short a rally to profit from an expected correction. Their refusal is telling. Analysis firm Sprout Money noted a clear unwillingness of U.S. bank trading desks to get in front of the freight train. This institutional memory stems from the 1980 Hunt Brothers crisis, when COMEX changed rules mid-game to avoid a delivery default. Banks today recognize similar delivery pressure patterns and will not bet against a physical squeeze. The convergence of these factors is spiking London lease rates, a major refiner exiting, collapsing COMEX inventories, and banks refusing to short to all within months of China's export restrictions, points not to volatility but to a systemic breakdown. Goldman's warning acknowledged this breakdown had already occurred. The rules have changed, and the pricing mechanism American industry relies on is failing. The mathematics are now in control. China's licensing requirements eliminated 91% of its silver exporters, effectively removing the 4,600 tons of annual export flow that lubricated Western markets. The remaining 44 approved exporters served domestic industry first. This forces a mathematical convergence. Goldman's revised 2026 forecast of $85-100 should be seen as a floor. Physical markets are already at $130. Citigroup projects $110. The 30 to 40% gap between COMEX paper and physical prices cannot persist. The CME Group raised silver futures margins by 30% in late December 2025, an emergency move echoing 1980. However, this can only deter financial speculators, not industrial consumers who need metal for production. The predetermined schedule makes resolution unavoidable. March 2026 options expiration will bring approximately 65 million ounces of delivery pressure into the COMEX system. Two outcomes are possible. Either COMEX imposes 1980 style trading restrictions, destroying its credibility, or paper prices rise to converge with physical market realities, $110, $130. There is no third option where physical prices fall to meet paper prices, as industrial demand is consumptive, not speculative. Goldman's warning about extreme volatility in both directions thus makes perfect sense. They are not predicting price moves but warning that the pricing mechanism itself is breaking down. When this happens, volatility becomes unpredictable because standard models fail. For American investors and manufacturers, the implication is clear. The reliable paper pricing system for silver is undergoing a fundamental restructuring. The extreme volatility is not speculation, it is the inevitable result of mathematics confronting physical reality. Paper promises can be printed, physical metal cannot. This collision is now unfolding on a predetermined timeline that began on January 1, 2026. This